Welcome to you both. David, you heard us talking there, Steve and I. It is somewhat interesting to see the way the stock market has reacted to this. And I wonder if it's just a matter of, the stock market had built in or was building in a greater prospect of a soft landing, and now they have to reduce that a little bit. I know you were getting a little bit cautious about the possibility for further equity upside, given what the Fed was up to here coming into this week. What strikes you about the market reaction today?
So I really agree with a lot of what Steve said, and I think the comments that he took, the excerpts that he took from Jay's speech were really the important ones. These guys are not in any hurry to make a turn or a pivot, and I think they've actually been quite steadfast in that statement, and there was some wishful thinking on the stock market side. But more importantly, Mike, I think the stock market, when we were touching those June lows down at 3650 on the S&P, we had just gotten everybody pumped up for even more downside. We had all these folks talking about 3,100 or below 3,000. And really that's why I think the stock market had the rip that it did. We had a lot of bad positions, a lot of people who had pulled themselves out of the market. They were feeling somewhat comfortable that they had outperformed the S&P. And then as the S&P started to rip back above 4,000, they were all underperforming the S&P, and they all stepped over themselves to get risk back on. And I think that's why we were up at 4,300 and change not long ago, and why the Fed's message kind of hurt a little more than usual. So I really think it was summertime positioning that drove a lot of this.
Yeah, there's no doubt, I guess, there are exacerbating factors that are related to that. Peter, broader context in a way here is the Fed is now in the complete mirror image stance that it was in when it was saying we're going to keep rates at zero until we see the labor market tighten more than it ever really tightened in prior cycles. We are not going to flinch at the slightest turn in the unemployment rate. That was the line, right, going into this tightening period. And in fact, we're going to let inflation trend even higher. Now it's acting as if it's again a one mandate Fed, except the mandate is whatever it takes on inflation, and we're not going to regard what's necessarily happening in terms of the wear and tear on the economy.
It's a great point, but also highlights something that Jay Powell has realized, that in order to have sustainable maximum employment, you first need stable prices. And you do point out correctly that, yeah, they prioritized one side in 2020, 2021, and then flipped it. But over time, it's stable prices that is really the foundation of a healthy recovery. And I think that that's an important distinction in Fed policy, where they went from this asymmetry approach or symmetry approach on inflation, and as you highlighted, mandating or wanting those jobs back that were lost, to focusing on inflation that affects everybody, whereas unemployment affects only a small group of people.
Right. And so they are not, David, going to, anticipate a favorable turn in inflation. They've been saying this for a while, of course. They need to see multiple months of evidence that it's going in the right direction. But there's always, the market's effort to see around the next corner is going to have people asking, well, the leading indicators of inflation might actually start to become a little bit more benign, and maybe whatever the Fed is saying right now, realities might mean something different next year. Is that not something that an investor should engage in right now, David?
I think Jay told you something a little bit different, Mike. I think he said, look, he didn't say this explicitly, but he said, look, we just had like the biggest miss on inflation that we can remember at the Fed, anybody sitting around that table. We're sort of akin to, sort of misses that were happening in the 70s. Thankfully, inflation expectations are anchored, 5-year forward, 5-year break-evens, and the survey data are really holding in remarkably well. But the Fed doesn't want to play with that. It's going to stay in a Volcker-esque structure for a lot longer than people probably think. And I think that's what Jay was pushing today. He even invoked some old Volcker quotes in his speech today. And that's been something we pushed really hard on at Jefferies, that this was kind of Jay's Volcker moment. He's staying with that. And he's going to make sure that we don't get the 70s, that we don't get an unhinging of the inflation anchor that Peter was just talking about. The most important thing for long-run growth is having anchored inflation expectations. Jay knows it. Peter was just talking about it. And I think this speech was all about making sure that we think about the long run and not get too caught up in a little bit of short-term pain. It's just not that important in the big picture.